We're going to talk about two things. Tactical positioning. This is what I think is going to happen. This is the kind of risk reward I'm willing to put on. And the other is income generation.
My name is Andy Bevers. I work for Cboe Global Markets. Today, I'm joined with two of my associates, Henry Schwartz, who's the head of our Data and Access Solutions client engagement team, and Vince Cicco, who's a member of my team on the derivatives coverage side. Vince focuses on the retail client segment explicitly. I focus on more of the market makers, but I run the overall U.S. members team. So what that means, we really deal with the engagement with respect to any of the member firms of our option exchanges. So that could be market makers, clearing firms, floor brokers, the entire gamut. So we own those relationships. For the exchange side, talk through some of the disclaimers here real quick. Obviously, options ensure that you understand the risks associated with trading options. Anything that we say up here is for informational purposes only, no recommendations, so kind of the standard disclaimer there. Again, quick update on me. Do want to take a quick moment to thank, first and foremost, Robinhood and the team for allowing us the opportunity to speak up here. As I think you guys are aware of the announcement the other night from Vlad with respect to Robinhood supporting our index options. Obviously, we're very excited about it. We think it's a great opportunity. We've had really good engagement with the Robinhood client base over the course of the past couple days, people coming up to the booth, engaging with us. So real quick before we kick things off, just by a show of hands, how many of you trade options through the Robinhood platform? Great, awesome. How many of you have interest in trading index options via Robinhood? Awesome, love it, good stuff. So yeah, we have great partnership with Robinhood. Really appreciate them giving us the opportunity to present here today. Again, the partnership's really strong. I say it all the time, right? You guys as clients of Robinhood are an extension of that partnership. It's really important for us. So do want to take a moment to thank also our Cboe team who's been here to support us over the course of this event. It's been really great. It's been awesome engagement. So really happy to see it. I'm going to talk briefly about Cboe, who we are, what we do as an organization. I'll offer a brief history lesson on kind of how the U.S. options exchange ecosystem has evolved over the course of time. I'll hand it off to Vince from my team. He's going to talk about the features of index options, and Henry Schwartz will wrap us up, offering up some examples, real examples of index options trades, some use cases with respect to index options as well. So I do want to begin briefly by talking a bit about who we are, what we do as an organization. So again, I'm certainly not going to read from the slides, but our mission, I do think it's important to call this one out, to build a trusted, inclusive global marketplace that enables people to pursue a sustainable financial future, right? Super important. We're very collaborative. We're very partnership oriented. What I do like, two words that I like to call on this slide, trust and innovation, right? I think we've established ourselves as an innovative thought leader. We operate in a very complex financial arena. I think that we've established ourselves as being thought leaders in the space, and we really do take pride in partnering, collaborating in order to come up with novel, unique, and efficient solutions to complex trading problems. I think that we've also done a really nice job of establishing ourselves as innovators within the options industry, as far as leading the charge with respect to industry initiatives that are helpful to just really option adoption and trading within the space. Talk a little bit about our journey. So we opened our doors as the first U.S. listed options exchange in April of 1973. On the date that we opened, we only traded calls. There were no puts even available at that time, believe it or not. The day that we opened our doors, we listed options on 16 symbols. We traded a total of 911 contracts, right? So juxtapose that with what we see now. Just on the option side, We operate a total of 4 options markets. So Cboe is our main market. We do have a physical trading floor with respect to Cboe, and we offer electronic access to that market as well, all the products that trade there. Cboe is the exclusive home of our proprietary index products, most notably SPX, VIX, Russell, and the MSCI index suite. So we'll move on to 1977, right? So puts are introduced, and Cboe establishes the Options Institute, right? Education. You guys have heard a lot about it. Recurring theme, something that we're very involved in. We like to meet clients where they're at, so to speak, and partner and be part of that journey with respect to them getting up the curve, with respect to learning to utilize options and trade responsibly and intelligently. 1983, SPX options are introduced. Interesting aside on this one, we listed on that in 1983, we listed both OEX, which is the S&P 100 index options, as well as the SPX, which are obviously the S&P 500 options. OEX was actually much more liquid, and most of the volume was transacted in OEX for the initial, call it decade plus that those products were offered. And over time, as clients were looking for broader based index exposure, liquidity transitioned out of OEX into SPX. Today, we trade a couple hundred contracts per day in OEX, and we trade approximately 3 million SPX shares per day. So a lot of good growth with respect to the SPX suite. 1993, we launched the VIX, the volatility index. For those of you that aren't familiar with it, VIX is a measure of estimated S&P 500 volatility over the course of the next 30 days. Because we have the exclusive licensing agreement with S&P Dow Jones, it gives us the ability and the flexibility to offer futures and option products. We do operate a fully electronic futures market, CFE, as well. So on Cboe, C1, we offer cash-settled VIX options. On CFE, our futures exchange, we offer VIX futures, mini VIX futures, and just this past Monday, we introduced a mid-curve style VIX options on futures product on CFE that settles to the front month future. So we're excited about that offering and to see where things go from there. Not indicated on this slide, in the year 2000, we see a sea change in the industry. So up until that point, you have 4 exchanges that have traded fully open outcry face-to-face, right? So you have Cboe, PHLX in Philadelphia, the American Stock Exchange in New York, and the PCOS in San Francisco. 2000 ISE comes live as the first fully electronic US-listed options exchange, and it really kind of forces the hand of the entire industry to pivot and offer electronic access to the products. We were certainly no different in that regard. Cboe, we now offer electronic access to all the products in which we trade, as well as we still have a bustling and thriving open outcry floor situation. Traded SPX, VIX, all the products listed on C1 do trade in open outcry. There's a lot of open outcry and face-to-face interaction broker activity with respect to VIX and SPX, probably above and beyond the other products that we offer. 2010, Cboe goes public. 2022, up to that point, we'd offered Monday, Wednesday, and Friday expirations in SPX. 2022, we add Tuesdays and Thursdays. So now we've got an expiration in SPX expiring every day. If anyone caught Fred Tomczyk and Steve Quirk's panel earlier this morning, I know that they talked a lot about this. The amount of retail adoption with respect to short-dated trading specific to our index products has been pretty impressive to see. If we roll it back to just before the pandemic, we were trading on average 1.5 million SPX contracts per day, with the addition of Tuesdays and Thursdays rounding out the daily expirations with SPX. Like I indicated previously, we trade on average about 3 million, over 3 million contracts per day. A lot of that growth, quite honestly, almost all of that accretive growth has been directly attributable to retail, which has been great to see. 2022 also sees us move to our new corporate headquarters, the old post office in Chicago. Phenomenal space, beautiful space, both more importantly to you all. We also move our trading floor. So we moved to a brand new trading floor, 141 West Jackson. We had been in the old trading floor since 1975. We actually were in our original space for the first 2 years that we were open through 1975. So completely revamped the space, updated all the technology, infrastructure. It's been great. A lot of attention. A lot of people have been very interested in what we've got going down there. If by chance any of you are ever in Chicago and have the opportunity to come down and see it, we'd love to show it off. It's really impressive to see. 2023, nice bookend for us. The 50-year anniversary of Cboe, right? So it's been great. It's been a fascinating journey. I actually started my career on the floor of the Cboe trading floor as a floor broker in the mid-90s. Stepped away from the floor for a period of time. So coming back to Cboe for me back in 2019 really allowed for my entire career to come back full circle. It's been a phenomenal experience, phenomenal organization. Our impact, let's talk briefly about this one. Like I mentioned previously, when I initially introduced myself, I very intentionally referred to our organization as Cboe Global Markets, not simply Cboe, not simply CBOE. That was very intentional, right? While we certainly established a presence and a name for ourselves initially as the first U.S. listed options exchange, we've in truth come to grow and expand across regions, jurisdictions, and asset classes meaningfully over the course of the past, call it 5 years. We operate options, futures, equities, FX, crypto. We trade all those asset classes. We operate across 12 global offices. So again, our main office is in Chicago. We have significant presences in Europe, Asia Pacific, and a number of other destinations. We do operate 27 markets globally, right? So pretty expansive reach, pretty impressive growth from our perspective. We do have over 1,600 associates around the world. I'll touch upon some quick call-outs here at the bottom. We operate 4 U.S. equities exchanges. We execute $64.56 billion of notional per day there, so pretty meaningful presence. We trade over 11 million option contracts per day on our 4 U.S. options medallions, 9.24 euros of volume traded on our European equity markets, $47.6 billion of FX volume per day, $4.96 billion worth of notional traded in our futures markets, CFE. Capabilities, I'll talk briefly about this. I've already covered the asset classes that we're involved in. As far as derivatives are concerned, we do have an exclusive licensing agreement with S&P Dow Jones, FTSE Russell, and MSCI. Gives us the ability to list their index products exclusively on our exchanges. So a little context with respect to that, right? When you think about single name equity options, they trade on 18 exchanges across the United States at this point, right? So if you run an Apple option, for example, via Robinhood, that option trades across all 18 of those venues. From your perspective, you can care less where it's routed. You want to know that you get a seamless and efficient execution experience. So that's a very competitive, obviously very competitive space. For the most part, I would say that those venues tend to compete on price and functionality more than anything, and I think that we are a leader from that perspective. I'll talk a little bit about our proprietary index product suite, like I mentioned previously. So S&P gives us the ability to list a few different flavors based upon client size around the S&P complex. So we do have our large SPX contract. We also have a small, a mini SPX contract, 1/10 the size of the large S&P contract. We list RUT and mini Russell small cap index options through the FTSE Russell agreement, and also the MSCI suite. We do have a number of products there as well. I've already kind of covered the U.S. listed options perspective here. I guess the last thing I would like to talk about is partnership and collaboration, right? Super, super important for us. We're very engaged with the market participants transacting on our markets within our products. Like I mentioned previously, we really do pride ourselves on that level of engagement, that level of responsiveness and innovation. It's a key hallmark of the way that we approach our business and the engagement and interactions with our client base. So it's something that we take a lot of pride in. We have a lot of really smart people working within the organization that certainly are not shy about putting pen to paper and solving some of the complex industry situations that present themselves. With that, I'm going to go ahead and hand things off to my coworker, Vince Cicco, who's going to talk about the features of index options.
Hi, everyone. So again, big thank you to everybody who joined here. I was tying my shoes back there, so I didn't get this show of hands. How many people at least have some familiarity with index options in this room? So maybe about half. And many of you were probably in the presentation in the other room a few minutes ago, or a couple hours ago, was Steve Quirk and Fred Tomczyk, our CEO. They talked a little bit about options, and Fred had spoken about some of the benefits of index options. So some of this is going to be a repeat, but I'll cover a couple different distinctions and maybe go into those with a little more detail. So just, I think off the top, we're talking about introducing this new asset class. And the reality is, I want to be very clear that there are some distinctions, but at the top, there's more similarities than there are distinctions between index and ETF and single stock. So you guys are very familiar with ETF and single stock. Both of them, you could trade in and out, right? If you buy an SPX option, you could sell it. It's the same mechanics as it is with if you're talking any other options you typically trade. Both have 100 multipliers. There's the vast majority of index options have 100 multipliers, and everything that is going to be available via Robinhood has a 100 multiplier. You can generally trade the same strategies. If you do credit spreads or buy outright calls, buy outright puts, same thing between index and ETF. They're based on similar, especially if we're talking SPX. And in a lot of this presentation, I'm going to cover XSP. I'm going to mention XSP. The reason being is it's notionally the same size as SPY. So if you're familiar with trading SPY, XSP is our 1/10 version of SPX, which is almost exactly the same size as SPY. So if you're comfortable or familiar with trading SPY, XSP is the index version of SPY, which is an ETF option. Again, based on similar broad-based indices, SPX, XSP, SPY, all based on the S&P 500. Nearly identical pricing models. There's some minor distinctions because indexes don't pay dividends. There's some other distinctions that Fred covered on stage, which I'll cover a little bit more in detail here. But for generally, if you're familiar with it, if you're familiar with the probabilities or implied volatility or Greeks, generally you're going to line up pretty closely between those products. Deep liquidity on both, like SPY's got phenomenal liquidity. SPX as well is one of the deepest markets in the world. The broad market exposure, this is one distinction where ETF options, I wouldn't say it's an advantage, but there's a difference between index and ETF here, especially with the ETFs we're talking about. The S&P is obviously a broad-based index. If you're looking for very targeted exposure, if you're looking for exposure on Apple, obviously you trade Apple, right? If you're looking for target exposure on energy, there may be an ETF that you trade. Broad market exposure, both covered equally well with the index and ETF options. Index options typically do incur additional fees. They were announced yesterday. I believe it's 50 cents at Robinhood for an SPX contract or for an index contract, and a little bit less, 35 cents if you're a Robinhood Gold customer. So those were the mostly, we're talking about similarities there between index and ETF and single stock. Here's some of the features that Fred covered on stage, and I'll cover them with some examples here as well. Just in summary, cash settlement, tax treatment, European style exercise, certainty of settlement, and extended access, which we'll cover a couple different flavors of that. So let's cover cash versus physical settlement. I'd say if there's one single benefit or feature of index options, I mean, for some people it's a benefit, for some people they may prefer the physical settlement on the ETF side. But just to cover the distinction here, again, we're using XSP because notionally it lines up. I cheated with numbers a little bit in that XSP and SPY don't trade identical. They usually trade about $1 or $2 off, just because of what, like I mentioned before, ETFs do not, or indexes don't pay dividends, so there's differences in the pricing model. But in general, they're pretty much one for one correlated. If SPY is up on the day, XSP is going to be up on the day as well, right? So the example I'm going to use here, both XSP and SPY closed at 476.68 on January 12th. You're long both the 475 call in XSP and SPY, just one of each. So at expiration in SPY, if you're familiar with trading SPY, or this even goes with single stock, right? At expiration, assuming you have a money account, let's say you have the money in the account to exercise the position, customer exercises that call option and has to put out, at the time, I mean, it shows how much the market has ripped this year. At the time, it was, you'd have had to pay $475 for 100 shares. It's actually closer to $580 or $590 now, right? So that's a $47,000 cash outlay. Right now, it's higher, like 58, 59,000. The catch here is that you're long that 100 share residual position in SPY, right? So maybe you want that position. If you don't, you have to figure out how to manage it, whether you trade it after the close. Or you just take that market risk into the following trading day. With the index, the important thing to remember is there's no shares of an index, and that leads to some of the distinctions that we're talking about here. So because the index is a derived value, it settles to cash. You're not getting delivery of shares. It settles to cash, and is basically that's it. Like, there's no residual market gap risk. You get a credit or a debit to your account based on where the stock closes or the index closes. And in this case, again, 476.68. The strike price on the call was 475. You made $1.68 times your 100 multiplier is $168. Theoretically, you've made the same on both positions, right? But in the SPY, you actually have that position. You're long the 100 shares, so you have the market cap risk. European versus American style is probably the second benefit, second feature, which people most talk about when we're talking about index options. Again, index options, we're talking about here SPX, XSP, VIX, and RUT, which will all be available via the Robinhood platform. In an index, there is no early exercise or assignment, right? You can't take possession of shares. There are no shares. So there's no early exercise. The flip side is there's no assignment. You cannot get put into a position and be short 100 shares. Now, contrast that with things that you may be more familiar with trading, SPY, Meta, Google. It's possible you get assigned before expiration. Obviously, you have, if you want to call it a benefit, you have the benefit of exercising before expiration, but the flip side is you are at risk of being assigned before expiration, so you aren't in complete control of your position. And that happens quite often before dividends, with puts. Nowadays, it could happen a little more often than it had been happening in recent years because there's interest considerations. One thing, again, to remember, you can trade in and out of positions. You're not stuck in an index position. You just can't exercise it, right? But you could buy and sell it and close just as you can any other position. So that's a pretty... I'd say when we pull our customers or end users, that would probably be number 2 or number 3 in terms of the features that people are most attracted to. Contra assignment implications. So this is sort of like an offshoot of what we were talking about on cash settlement. So we're going to use the same example on January 12th. Stocks close, or the ETF and the index close at 476.68. So XSP and SPY, you're short both a 477 call in both of those. So you think about, we'll start on the right side with the ETF, what you're familiar with. If you're short the 477 call, what's going to happen if, at the market closes at 476.68, you're short the call, and then all of a sudden, after the close, there's some geopolitical news and the market's up to 478 or 479. You're short the 477 call, yeah. And it goes up 3-year strike. Yeah, so you're short, you're right. So the person that's long is going to contra exercise, and they're going to put you in, you're going to be short, they're going to exercise, you're going to be assigned, right? So basically, you're going to be probably short 100 shares if you get assigned. And that's just based on that after hours market move, where the person on the other side has control of whether they, because you have until 5:30 I'm not sure on, with the OTC, you have, I believe, till 5:30 to exercise. Different brokers have different policies on how late they'll let you exercise in the day, but there is a window after the close where you can either contra to say you want to exercise or you don't want to exercise. In that case, you'd exercise, and you being on the short side of the contract would be short shares, right? So index, the close is a close. It closed at 476.68. It was out of the money. There is no, there's no contra. So it's just basically the position's done. This one we talk about, we're not tax advisors, but, Fred covered on stage as well. There is potentially favorable tax treatment. So regardless of holding period, index options are subject, they're 1256 contracts, they're subject to 60-40 tax treatment, which basically means 60% long-term capital gains, 40% short-term capital gains. Typically, your taxes are based on holding period on options that you're trading right now. And that, since options holding periods are often less than a year, they're short-term capital gains, that would be, short-term rates are higher than long-term rates. So the example we have here, $50,000 in trading profit, trading pre-tax for the year, there's actually a $5,100 $5,100 tax savings, so $5,100 increase in your after-tax income, right? So again, you'd want to consult with your tax advisor on anything when we start talking taxes, but that's obviously a generally recognized rule. There's one other thing with the 1256 contracts is you typically mark to market at the end of the year. So that's something to be aware of as well. Finally, extended access, and there's a couple different flavors of this. So Vlad had mentioned on stage, Robinhood obviously wants to, be lit up at 24 hours, 24/7 or 24/5 or whatever, right? At launch, these are only going to be available till the 4:15. As that window opens, Cboe does make index options available around the clock, and that, as Vlad said, they're looking to do that potentially next year. So we have like a 21/5, and 21 hours a day, 5 days a week. The other thing that's just probably more relevant at launch for once Robinhood goes live is if you think about at expiration, a couple of things we talked about before, if you don't have $59,000 in your account, or if you don't have substantial money in your account, likely at 3:30, a broker, and this is clearly not just Robinhood, the broker is protecting you, they're protecting themselves, and they will begin to sell out positions and close out positions if you don't have the funds in the account to take possession of the shares, right? Typically that's such in 3:30, or they do not allow you to open after 3:30 on expiration day. That's not really an issue on the European side because there's no, you're not you're not at risk of taking possession of shares, so you can extend your trading window. So there's two things. Again, you could, next year when they go fully around the clock, or 21/5, you have that extended access, but you also have the extended access within the trading day, which is relevant almost on day one, right? So that's about it. We'll be available for questions afterwards. I'm going to kick it over to Henry. He's going to work through some example trades. And in between, real quick, we're going to do a quick video. It's like a 20-second just video of their just to show SPX in the Robinhood platform.
Pick up the vibe, always lit, even outside. Smile on my face, don't kill my high. Never stagnate, just passing by. Can't stay still, don't ask me why. Where to next, let time decide. Me and the world see eye to eye. Life's a journey, enjoy the ride. And get vibey with it. Sweet on the decks, we live in the mix. Get with the bass one time, let hit make the room go crazy, cause we don't miss. I just
Very cool.
get so far.
Good morning, everybody. Good to see you guys. And I like the interactivity, so feel free to interrupt me and yell out. I've been trading options for a solid 30 plus years. I actually started trading index options at the beginning of my career, and I kind of moved around a little bit. But so this is kind of like bringing things back. And what Vince and Andy have been talking about. If you're trading anything, index options are generally simpler. So it really is the fact that Robinhood's going to offer this type of option. It's easier. It literally is. So I'm going to cover a couple things. I'll try to go quick so we do have time for questions. The indexes have been around for about 35, 40 years. The typical use case for index options, especially SPX, and SPX is kind of the lion's share of the index business. XSP is the same exact thing, just divided by 10. It's a different product, but SPX is the S&P 500 index. XSP is also the S&P 500 index, just divided by 10. Traditionally, SPX has been an institutional hedging product, okay? The numbers in SPX are phenomenal. We're talking $2 trillion of notional value a day trading in SPX. This is on the Cboe floor. About $2 billion of premium, of actual option premium trades daily in SPX. Half of that volume in SPX, which is around 3 million contracts a day, is in the zero-day options, and we're going to talk about this a little bit. But traditionally, it was a hedging product. Basically, if you're running a multi-billion-dollar portfolio, you could buy puts in SPX, you could sell calls in SPX. That really was kind of what people did through the 90s and through even the early 2000s. And they still do. That still is actually kind of the dominant volume, especially in the longer-dated SPX options. The other thing that SPX is used for traditionally is arbitrage and volatility trading. Really interesting, basically MIT quants at multi-billion-dollar hedge funds, things like Citadel, Millennium. We're not going to talk about that. It's really interesting, but the barrier to do that is pretty high. What we are going to talk about is what I think SPX and index options in general can be used for by retail traders. And I continue to trade every day. And SPX is part of what I'm usually kind of doing things in. We're going to talk about two things: tactical positioning, basically saying this is what I think is going to happen, or this is the kind of risk reward I'm willing to put on. And the other is income generation. And this was mentioned earlier. These are kind of the two trades that I think make a lot of sense in this product. So we'll start with income generation. Has anybody here ever traded a zero-day index option? Okay, I know you haven't done it on Robinhood yet, but you will be able to. Zero-day options have come to be a very, very popular trading strategy. They just use regular SPX options, but as Vince mentioned, now we have an expiration every day, so you can trade it the last day, and the last day is when most of the activity happens in these contracts. So here was my trade, and these are real trades that I did a couple weeks ago. I wanted to make a little bit of money, okay? I wanted a short-term gain. It was going to be a zero-day trade. I was cool with a 10-to-1 risk reward, okay? Meaning I'll make $100. I don't want to risk more than $1,000 if things don't go the way that I'm expecting them to or the way that I'm hoping for them to. And I want it to be simple as can be. And what Vince was just talking about with the contrary exercise and the nastiness that can kind of come into physically settled options in the last kind of part of the day, it doesn't exist in indexes. They just cash out. Even if it's 2 cents in the money, you get the 2 cents. There's no uncertainty. My view on September 23rd, so this is 3 weeks ago, was basically that we weren't going to have a crash that day. Okay, it's a risk I was willing to take. One of the things that has been well, Tom Sosnoff has said, and I know that, he's part of the DNA of the whole business, is that not taking enough risk is actually a bigger concern to him than people taking risk. And you really have to think about that, is if you have some level of capital that you're comfortable risking and you don't, or worse yet, you leave it in a checking account that doesn't get any interest, that's an incredible lost opportunity. So I was comfortable with taking a little bit of risk on this day. I was not expecting a crash. I can't predict the future, but that was what I was willing to put a little bit of money into. And that was it. I'm like, I don't think the market's going to crash today. So my plan was to find a vertical put spread in SPX. It's also called a credit spread. And then do a very small trade that I wasn't going to have to babysit, okay? I'm not a fan of trading sizes where you kind of have to keep an eye on it, or it's kind of stressing you out, or you're trying to have lunch and you're kind of opening up the app to see what the market's doing. If you do a small trade that's really not going to bother you much if it goes the wrong way, you just don't have to stress about it. So this is an SPX options chain. This is in the Cboe Live Vault platform, which is one of our platforms, but obviously you'll be able to see index option prices in the Live Vault app, and eventually the Live Vault desktop platform too, which is pretty exciting. So my goal is to find a vertical put spread, okay, which you guys have probably all seen the hockey stick, right, type of charts, right? This is a spread where you sell one put and you cover the risk with one that's a little bit further out of the money, okay? I wanted a 10-to-1 risk reward at the worst. So what I ended up picking was the first 10-point put spread, right, the 56.80.90, where the one that I sold was going to get me at least $1 more than the one that I had to buy. Okay, just so you know, and I'm sure you've run into this, the margin required for a naked option sale, as put or call, is pretty significant. And in SPX, when it's a $5,000 index, you're talking about a lot of money. A naked put in SPX, I believe you have to put up about $100,000. Okay, nobody's going to do that. But in a spread, the margin is just the total difference between strikes. Okay, so it's $1,000 that's required as margin to be short that put spread. Okay, the reason it's $1,000 is because that is the absolute maximum you can lose in that spread if things go wrong. That's it. There's no uncertainty. That's in a physically settled ETF or stock spread. It gets a little bit wonky. In general, the risk reward is similar, but things can get nasty at the end. So I picked those two strikes and I put in an order. Okay, so this is actually the print for this trade. Trade Alert is the platform that I invented in around 2005, and Cboe ended up buying us during COVID. That's why I work for Cboe. And this is kind of how we present the trades. But basically what you can see is the two legs of the spread. Okay, I'm selling those 56.90s. You can see they traded for $2.80. That was my sale. And the covering side was $1.65. Okay, so that's a net credit of $1.15 for this spread that has a maximum value of 10. Okay, the trade was entered as a complex order. Okay, you can leg into a spread, but there's really no reason to, because the way that the market works now is when you put in a complex order as a put spread, the liquidity side, which is the market makers, are evaluating that in milliseconds as a package. You're gonna get better pricing going in as a spread. So I collected $1.15 on this spread. Okay, so and then it's nice and simple. So $1,000 maximum risk for the whole thing. We already collected $115. So the true actual worst case net loss is $885 on each one of these. And the strike, okay, you can, when you kind of pick what strikes you want to get into, it's not rocket science, but you got to think about, okay, what am I really risking? Well, this trade would start to lose money if the market was down 0.5%, okay, which the market moves 0.5% often, but on this day, that was the risk that I wanted to take, and that's it. And so in this case, that was a 7.7 to 1 risk reward. And this is a 0-day trade. This option expired. This trade happened at 11 New York time, which is where I'm from, and it was going to expire at 4 o'clock, okay? This is what happened to this spread, okay? So the lines here, I love to do data and really complicated charts. I'm very sorry, but you have a few lines here. The pink line is SPX, the cash index price, okay? So you can see it was around 57.20 when I did the trade, and that's why that first strike is about 0.5% below. And then the dark lines, or the solid lines, are each piece of this spread, but what really matters is just the difference between the two. So that blue line at the bottom, that's really what I'm short, okay? I collected money, and if that were to blow out to $10, which is maximum value, I would lose money. But what ended up happening kind of over the next, just look at the light blue line that's at the bottom. It kind of held its value until about 1 o'clock. And you can see SPX sold off a little bit. Okay, it's lower than when I got in. And the spread value was about the same. That's kind of time decay working in my favor while the market's going the wrong way for my trade, but then the market bounced. But the truth is, even if the market hadn't bounced, we were still well above that 56.90 strike, right? So I was still everything was looking fine. And like I said at the beginning, this was a trade I wasn't going to watch anyway. Like it just was not, I can handle, or at that time I was perfectly comfortable. I wouldn't have been happy, but if I lost $1,885, I would have been, all right, well, that's annoying, but maybe I'll do this trade again. And in the 0-day trading world, there's a lot of people that do this kind of systematically every day. There's some people that do this multiple times every day, and there's some nuances to it. And you could do a call spread instead, or some people do a call spread in addition, at which point, if you think about it, you're just kind of bracketing the market and saying, well, I don't think we're going to crash, but I also don't think we're going to run up 1%. And you can kind of collect a premium on each side. Now, think about it, like you can kind of get whipped around if the market, they can't both expire worth anything. The market has to finish somewhere. But it can be stressful because you could be down and one spread could be looking bad and then you could run back up. And where people kind of get hurt is panicking, saying, oh, I don't want to lose the $800, so I'm going to close it out at $600 loss, and then the market flips on them. So like, you really, when you're trading, you want to have a plan for this is how it's going to work. Because when you start making stuff up as the market's moving around, you're going to make poor decisions. At least I would. Okay, that's one trade. That's it. I made whatever $1.15 times 3. So there you go, $445. 345. Yeah. Less any transaction costs. There's a little bit of a commission or a contract fee on the indexes. And then this is the second trade. Okay, this was later the same afternoon, I think, or it might have been the next day. This is much more of a directional bet. Okay, it really, you want to trade your style. You want to trade what kind of makes sense to you at that time. This was September 23rd. I think I did it. I was looking for the market to kind of climb into quarter end. Okay, that was my personal view on what I thought the month would look like. But I also wasn't going to bet the farm on anything, right? And nobody ever should. So again, I wanted a limited risk trade. I'm willing to risk a few $100 for what I think or hope is going to happen. And in a long option, it's a different profile, right? You're picking up convexity. It's the hockey stick going up in this case, which is a call purchase. One of the other reasons that I was comfortable kind of buying an option is because VIX was at 15. Okay, VIX is a measure of volatility that comes out of SPX. I'm sure you've seen it on TV. The VIX itself has been around for a long time. It uses 30-day options in SPX. There's actually a VIX 1D, which uses the daily options, basically today and tomorrow options. There's a VIX 180D. There's VIXs for many terms, but it tells you how expensive the options are. Okay, you want to get comfortable with kind of how it moves. But for me, a VIX around 15 is kind of the low end of things. I'd much rather own an option at that VIX level than be short it. And like I said, I thought the market was going to go up for the rest of the month. That's what I was at least looking for. So in this case, it's a straight long call. Same deal. My style for trading is be comfortable with what happens if it doesn't go your way. I didn't really want to do a trade where I was going to have to say, okay, well, if it's down 50%, I'm just going to stop myself out. Because in my view, you can do that with a larger trade, or you can just do a little small trade, and then you don't quite have to worry about it. And then the last part of my plan was if we did kind of run through whatever strike I picked, and the option was, I was making some good money on the trade, I would sell some other call and turn it into a vertical call spread, right? Because once you're making money on one call, you basically, if you sell another call, you're capping out what you can make. And that is legging into a spread the way that I said, don't do it if you're getting into a spread, but it can certainly be part of the plan for if things go the way you want. Now I'm going to take a little money off the table. You could also probably just sell part of the position. So a lot of numbers on the screen here, and I'm not going to try to make you understand all the Greeks for an option, but I did put in the Greeks kind of on a daily basis. So this trade would last a whole week. So on the 23rd, and I did this one in XSP, okay? Like I said, it's just SPX divided by 10. It's very, very similar to SPY, right? SPY is almost the same price level. It's the same thing, okay? But SPY is a physically settled ETF option class. This is an index. The strike that I picked was the where is it? 575s. You can see we were at 573.10 when I put on the trade. So I'm like, yeah, I think we'll get a couple dollars. I'm willing to take some risk here. And at the time of the trade, okay, options were around $1.75. I will mention the Greeks because you kind of have to. It was a 39 delta option, okay? This will show up in the platform, Greeks are estimates that come out of the Black-Scholes model or the binomial pricing model. It's an estimate on how much this option is going to move in value as the underlying moves. 39 delta tells you it's going to go up 39 cents if XSP goes up $1. Okay, it's an estimate. There's a lot of moving parts to this. Same on theta, actually. Theta was 22 cents. Okay, so I knew that option was going to melt 22 cents on a daily basis when I got in. So you have to be comfortable and not get surprised. And in call purchases, this is kind of one of the things retail traders, especially new ones, get a little bit tripped up by, is they bought a call, the instrument went the right way, and they didn't make any money. And that's because this option is a decaying asset, right? So this one I knew was going to lose 22 cents a day. In fact, if you think about it, it was an out-of-the-money call trading for $1.75. From now till the end, it's got to lose all of that value unless the market moves. So in a way, it's not linear like that, but you can just kind of estimate and say, well, $1.75 divided by 5 days of life. Yeah.
That.
And you have the weekend in there. So it's some other people think about that delta as a probability of getting to that strike. It's actually a decent estimate for that as well. So it's kind of had a 39% probability of getting there. So I bought a 5 lot of these options, and then I really just tracked it on a daily basis. Like I said, my plan was to just kind of let it ride. The first day, the next day it went up. Okay, market went up a little bit. This option price finished at $2 at the end of the day. So there's a little bit of P&L. I was up $105 net. The first day I bought it actually was down a little bit, right? Because the market actually finished a little bit below where I got in. One thing I'll point out especially in XSP, is you see the market, the yellow part is the bid offer, the quote on the screen that you will see before you make a trade, and you definitely want to pay attention to it. In this case, I paid that offer. Sometimes it's a good strategy. I think probably most of the time it's a good strategy to maybe bid in the middle and see if anybody sells it to you. So I probably could have saved a few pennies on the entry if I'd done that. But and then all I did for the next 5 days through that weekend, because the 30th was a Monday, was track that trade. So there was, again, by the 26th, it was up a little bit. Same thing, though. That option was still decaying, okay? And then on the final day, on the 30th, we did actually rally. It did finish in the money. It didn't make any money, though. It was down $270 all in, okay? There was kind of a couple chances where I could have gotten out, okay? But that wasn't part of my plan. I could have also tried to sell some other option to kind of offset what was happening and lock in a little bit of P&L. But this, and then just the charts at the bottom are really just kind of showing on each day what the dynamics of this trade was. Okay, the delta of that option did go from 39 to 100 because it went in the money, and that is what you're going for when you buy an option. You're much happier in the money than out. The one last thing I'll point out is, and this is kind of worth thinking about. I don't think to trade options that you need to be a theoretical options genius in terms of how pricing models work. But you do want to think about the basics, like, what exposure did I really get out of that, out of the premium that I spent? I spent $895 getting into this trade. The leverage that I got, okay, basically that was equivalent to, by the end, almost $300,000 in exposure, okay? Because once it was in the money, on that last day, it was moving penny for penny with the market, with XSP. And short-dated options have this kind of built-in super-duper leverage, okay? It can work the other way, right? So this is why, you'll hear horror stories every once in a while about somebody being short an option for 50 cents that blows up to $50 in some sort of like real major move. That's the kind of implied leverage in an option. And to figure it out, you're just doing the option price divided by the delta, okay? So think about if the delta was 1, then it's really just going to be the option price times the multiplier, and then that as a ratio of how much underlying exposure you're getting out of it. So I think that's it, and we have a good 9 minutes for question, and I will bring up my very intelligent colleagues, Vincent and Andy, and ask us whatever you want. Just don't take anything as recommendation. So. The question was how to hedge a position using VIX options. VIX is probably the most complicated kind of little niche within the industry, okay? Because VIX is a measure of volatility coming from SPX options. That's what the VIX index is. But there's also VIX futures, which are basically forward volatility kind of at each point. If the market crashes, VIX is going to go up. Okay, if the market crashes, VIX futures are also going to go up. The VIX options are really driven by the VIX futures. They don't care about the VIX spot. In that institutional hedging kind of example I said that indexes are traditionally used for, people buy, big hedgers use VIX call blocks, basically. A VIX call block, if you think about it, is the same as a put in SPX. If the market crashes, vol is going to explode, VIX call is going to make a whole bunch of money. If the market crashes, SPX puts are going to make a whole bunch of money too. There's more moving parts in VIX options. If you think about VIX has there's volatility in the VIX option itself. So you have this whole vol of vol. I don't usually kind of recommend people jump into VIX options to do much, just because it can be a little bit tricky. In the end, I really think the world is pretty efficient. So an SPX put or a VIX call are kind of going to get you the same bang for your buck. If you are really a volatility geek, and you really are paying very close attention, and the bet you want to make is that volatility goes up 4 points, that is a VIX bet. But if you think about it, like the SPX position also has a vega to it. Vega is how much things move by when volatility changes. So you can put on the same bet. One has a lot to do with how far the market moves. The other one has to do with how far the volatility moves. Those things happen together, but I would basically say probably paper trade it. Try to figure out, okay, I could have bought a 10 lot of these puts for $6, or I could have take that same amount of money and buy VIX calls. And then you can even, when you think about simulating what could happen, you don't have to move the market. Just go to the next strike, right? Because if you think about it, like a 5,700 put, if it's priced at $1, what will happen if the market goes down $10? Just look at the next one. Look at the 5710 puts, because they'll now be $10 deeper in the money. And that's what those puts should get to. Okay, there's times passing and decay and this and that. And then same thing for VIX. You just have to be very careful. VIX options are driven by the VIX futures. So, sorry, this is a long answer. If you were paying attention on August 5th when Tokyo was down 12% and the world was ending for a very brief moment, there was the VIX level itself got up to 60 briefly in the pre-market based on these overnight options, the overnight options trading. The VIX futures never moved nearly as much, and the VIX options are driven by the futures. So anybody that thought VIX going to 60 would make your 40 calls in VIX, maybe out a month or two, super duper valuable, they went up because the futures did go up, but they didn't go up to 60. So
I was long. They did not.
Sorry about that. I'll let them answer the next one.
Anyone else?
I had two questions. First, what's the difference mainly from trading SPY and trading SPX? And I'll wait for the second question.
The main differences would be, I think that's pretty much what Vince covered, right? So you've got the beneficial attributes of SPX versus SPY, right? Physical delivery of SPY is really the main consideration to account for. And then again, some of the beneficial features that Vince had spoken to previously.
So the SPY will, you said it's physical.
Physically settled, meaning that if you get exercised or assigned, you're taking delivery of the physical ETF.
All right. And the second question is not a self-report. I'm just very curious. I'm sure you guys have hired and fired traders. I'm not sure. I'm not going to assume that. But if in the cases that you've recognized a trader is not cut out for it, what kind of characteristics do you recommend we look for in ourselves? Let's say this is not for you. Put it away. Go learn more and come back.
Yeah, I mean, I'll take a first stab at that one. I mean, I think it's about anything else, right? It's about having an interest and desire to learn, right? And these are complicated products, right? So if you're going to commit to getting involved, you need to commit to taking ownership of your education and getting up the curve, right? So, I mean, it's really about how much time and effort you put towards getting a familiarity with how they trade, like Henry had alluded to, right? Paper trading is a great first step, right? Kind of get a feel for how the indices move and let that inform kind of the trajectory of how involved you get and how quickly you move up that curve.
Yeah, I would just add, it's funny, the efficiency and basically the tightness of markets and listed options nowadays has never been better for retail customers, for small accounts. So you don't have the handicap of like, geez, you got to make back this big bid offer spread and this big commission just to break even. That's how it was until Robinhood kind of got into the option game, at the end of 2017. So you're not
starting from behind.
Yeah, you're not getting screwed on the way in like you used to. You still can make mistakes and in terms of mentality, I think it's like you really have to, if you're out there to go try to make 100% a month, you got to be realistic. You're not going to do that without taking stupid amounts of risk. If people could make 100% a month, nobody's making 100% a month. So have very realistic expectations. And like I said, that trade, okay, I'm willing to risk $800 to make $115, and it worked. Okay, I'm going to try it again tomorrow. Oh, you know what? I got hosed because it was Fed day and the market did move 1%. And just start kind of refining your approach, I think but small. There's a lot of rules of thumb, right? Never risk more than, 2 or 3% of your account ever on a single trade. Like these things are really important. And that is what lets you get the experience to figure this stuff out.
Well, I was curious, this is also about VIX. Do you use VIX to inform your thoughts on where SPX is moving as opposed to applied volatility? Or do you use them in tandem or one versus the other? Love your perspective.
You don't want me to answer.
We do, I can answer.
I definitely keep an eye on VIX. VIX is great because you can do some real simple calculations. Like basically VIX divided by 16 is your one standard deviation kind of expected move, right? So VIX is at 32. The market's saying it's going to move. We're going to move 1% a day. But I also think it's really important. It's also like when VIX is crazy high, and volatility is mean reverting. So when VIX goes to 60 or 80 during a panic, it will not stay there forever. But it may stay there longer than you can survive, shorting it. But VIX is also 1 point made out of a strip of SPX options in 30 days out. I like to look at kind of how steep the volatility is. If you think about it, and you can really do this pretty simply, like what is an at the money to a 5% out of the money put spread cost in percentage terms? That moves around as kind of volatility shape changes. So VIX is kind of a number. It tells you how high vol is, but it doesn't really tell you if the market's incredibly concerned about a downside move or an upside move or what. And going into the election, it's really interesting. The VIX is high because of the election, so the market is kind of expecting or at least concerned about some volatility for a while. But you can really look into the options and try to figure out, is it concerned about a downside move or an upside move? That August 5th data, it's a little bit murky to look at, but the concern there was really a downside move, which makes a lot of sense because Tokyo's down 12%. So.